Hello, everybody, and welcome. Today, my guest is Qian Zhang. Zhang is a senior portfolio manager and a China bond specialist at Pictet Asset Management. Welcome, Qian.
Good morning, Thomas.
So, Zhang, today we want to discuss latest developments in the China fixed income markets. And so Chinese bonds have seen a lot of interest from investors during the last couple of months. How has COVID-19 changed the Chinese fixed income market?
Yeah, sure. You're spot on, Thomas. Last year in 2020, we did see quite a lot of inflows to this asset class. It was estimated about 160 billion of US dollars inflows to China onshore bond market. Inflows continue to be reasonably strong, and the Street estimate this year there will be additional 200 to 250 billion of US dollar inflow to China onshore bond market. Now back to your question, what has changed since COVID-19? I would say instead of the change, particularly within China fixed income market, I think is the relative position of global fixed income market versus China fixed income has changed. If you think about it, I would think of three major changes. Number one is in investors' mentalities. People started to think about shifting asset allocation to where the economic gravity is. COVID-19 has caused Asia perhaps to be a bit more advanced in terms of economic recovery. It came back from the crisis relatively faster and stronger. And given the fact that Asia, in terms of marginal growth, has already contributed the majority of GDP growth globally, so this has shifted the economic gravity a little bit more to the east and caused investors to think about allocating more proportional as well. That's number one. Number two, I would think is the relative yield difference between Chinese onshore bond market and the major development government bonds market. If you look at the yield differential between the two, it is still at a very healthy margin, and especially post-COVID-19 when global bond yield fell significantly. The third thing I would say is investors' recognition of the importance of liquidity, especially in the bond market. If you think about in March last year, there's a lot of bonds that you couldn't really move, even though you're high quality dollar bonds in some circumstances. But during that period, China onshore bond market could still provide reasonable liquidity with reasonable bid-ask spread for international investors. So it might become an alternative source of liquidity for international investors as well. So I think those three reasons perhaps make people more aware the existence and the potential benefits of China fixed income market, which is evidenced in the flows that we see in the past several months.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. Looking beyond the COVID-19 crisis, what are currently and in the near future the major influences on the Chinese fixed income market?
We would think of mainly two things. Number one is obviously monetary policy. If you look at the yield evolvement in the Chinese bond market versus, say, US Treasuries, the backup in yield has happened quite early in Chinese fixed income market since second half of last year, together with the quickly rebound of GDP growth after the Chinese authorities tackled the COVID-19 situation pretty fast. So that adjustment has been done in the China onshore government bond market last year in comparison with all of the major developed market government bonds market, which is happening right now. So the monetary policy stance from that perspective, the Chinese monetary policy has been, I think, has already shifted from a accommodative stance to a more on hold or neutral stance. So from that regard, we don't see an urgency of the central bank to further reduce rates or further hike rates on either side. So for us, it would be a bit more range-bounded situation. But saying that, with the expectation of global inflation picking up, I think the tail scenario for this would be if the US economy became very hot or overheated and significantly lifting up global demand, etc., it might be imported back to domestic Chinese market to cause potentially inflation pressure backing up, even though at the moment inflation is still well below the central bank target. In that tail scenario, we would think maybe monetary policy need to be a little bit tightened, but I would think that's more of a second half 2021 story. The second thing I think mostly will potentially impact the capital market, including bonds and equity market in China, are green financing. So we see this 2060 carbon neutral target that was announced late last year. Associated with that, we have already seen the emergence of green bonds new issuance from several key issuers in onshore China bonds already, and we would forecast this would continue to come and create new opportunities for bond investors in China domestic market.
So the trade conflict between the US and China is still a matter of fact, and obviously it won't go away overnight. So on the other side, the China trade surplus is rising again. What does this mean for the Chinese currency? What is your expectation for the Chinese currency?
Very good question. The trade surplus, as Thomas, you pointed out, has been rising. In 2020, the trade surplus is $533 billion US. I think in terms of its implication for the currency, that provides solid fundamental support to the CNY, which is the Chinese currency. Although we think the geopolitical events and headlines, such as trade conflicts, will continue to create volatilities in terms of the currency, but in the long run, the currency value is very solidly backed by the economic fundamentals. We think China is perhaps at one of its strongest moment in terms of economic growth versus the rest of the world. There's no strong fundamental thesis for the renminbi to depreciate, even though we don't think the very strong momentum of renminbi versus dollar, as we've seen last year in 2020, will necessarily replicate again in the same magnitude in 2021. But we think in the long run, the renminbi is economically or fundamentally well supported. And also we believe China will continue to push forward the renminbi internationalization, promoting using renminbi as a settlement currency for trading parties, trading counterparties, etc. And also associated with that, if you want to encourage people to use renminbi, you should create relative associated investment instruments, i.e. the bonds market and equity market, for people to be able to park their renminbi and use renminbi for their investment as well. So hence you see the associated opening of Chinese capital market, including both bonds and stock markets.
So recently we have seen some major defaults, especially from state-owned enterprises in China. So are we coming to the end of the implicit guarantees by the state, and are we currently observing some general shift in the policy of the Chinese government?
We have been anticipating gradually rising default rates for the past several years, and that is what is happening. And we continue to think default rate will gradually rise from here, from a very low base in the years to come. It is a structural journey as the Chinese capital market building its bankruptcy system. And also it is in the regulator's mind as well to gradually let go this assumption of implicit guarantee among domestic investors, to let the market do more work in terms of pricing, giving investors better risk premium comparing associated with the standalone credit fundamentals of the issuers. However, saying that, we don't see this becomes any kind of systematic risk yet. I think is the chance for active managers to do the due diligence, exercise care when it comes to credit selection. We do think in the longer term, it is a structural positive sign for the market structure development, and which is creating opportunities for active managers, I would say.
How about the yield spreads for Chinese bonds compared to the US, for example, and the Euro bonds? What are your expectations for the yields and the yield spreads for Chinese bonds?
The yield differential between the Chinese government bonds, which is single A minus rated, compared with any major developed market high quality government bonds, is still quite decent. We're talking about 200 or plus basis point versus the US Treasuries, and also a lot more versus European government bonds. Some of those are very low level or even negative territory. I would share with you two statistics here, Thomas. Number one is the Chinese 5-year bonds are yielding more than 3%, while about 70% of the developed market government bonds are yielding less than 50 basis points. Number two statistics is more than half of the world's bond stock that is yielding more than 2.5% are in China. If you want some yield in this fixed income world, it's very difficult to work around this. I would say perhaps the largest chunk of quality bonds that you can still grab some decent yield, provided the economic fundamentals to support the currency. I think that's perhaps a very solid statement for investors to consider.
China came out of the COVID-19 crisis very quickly in comparison to many developed markets. Will this be a lasting advantage for the Chinese economy and China capital markets?
We believe along with the vaccine injection rolled out in other major economies, global demand will continue to recover. So is production capability, etc. We believe this will be a positive for Chinese economic fundamentals, but any negative impact, I think, will be compensated by also better trade volumes this year as well. I would say perhaps the gap between China recovery very fast last year versus the rest of the world will perhaps be shrinking, but that marginal impact will perhaps be compensated by higher global demand and higher global trade volume anticipated this year as the world started to reopen. In addition, I think people read from the headlines last year, China also proposed this dual circulation policy during 2020 and will further boost domestic consumption. So we think these two factors will continue to support the economic fundamentals, even though I think I do recognize the marginal advantage of coming out from COVID-19 very fastly from last year will perhaps to shrink somewhat in 2021 as the vaccine shows out and major economics started to open, but that will be compensated by better global demand and better global trade.
So this was Qian Zhang from Pictet Asset Management. Thank you very much for being with us today and sharing your insights.
Thank you very much, Thomas.